right, welcome back, everybody. We're talking with Nick Sargen, Chief Investment Officer at Fort Washington Advisors in Cincinnati. So, Nick, we talked a little bit about Laszlo Barini. He's got a pretty upbeat forecast for the S&P 500. Based on his outlook, he says by the end of the year we could see about a 20% rise in the S&P, up about 14% from where we are. Do you buy all of that optimism in terms of his market outlook?
Well, I used to work with Lazaro and have tremendous respect, and he's been on the right side of the call. I'm optimistic, but not that optimistic. I'd settle for half of his gain for the year. And, Carol, the principal reason is I'm more based on fundamentals, is while the economy is improving, while corporate profits are improving, I do believe a lot of good news is priced in.
Right.
The other factor is that we now have this, our interest rate's going to be rising, Treasury yields. And if so, it's going to be harder to base the rally on multiple expansion as we had last year.
All right, so even though he points out, he goes, the negative case is neither compelling nor persuasive. He says the economy could have another dip, earnings could falter, inflation could appear, and Greece could default. Opinions are, as we have painfully learned, poor currency in the market. So, taking that into account, I mean, it's kind of a good point here. I mean, the psychology of the market has been kind of interesting to watch.
Yeah, so many people have said this is the least loved rally in history, and so that's actually been good. Again, if everybody was euphoric, then I'd probably be more contrarian. But as I indicate, it's possible his call. I just think it's on the outlier side because. To my way of thinking, what I have to have is, and I'm hopeful of continued improved corporate profits, but I just think that the bar is going to get harder as we get into the second half of the year because that's when earnings did start improving.
I mean, bottom line, the easy money, the easy earnings improvements have been made here.
That's correct, Carol, and that's why I think that right now, as I say, to me, the big call is the skeptics on this market say, all right, I grant you there's a recovery. They didn't see it, but they say, I grant you it's a recovery. But I just don't see the basis for a sustained expansion. Where I'm more hopeful is, and it's going to come down to jobs, jobs, jobs. As I say, this Friday, even if you get a 200,000 handle, it's not that strong because, say, the census workers are maybe 100, and who knows what the swing in weather is worth. So I discount that. But I do believe we're turning into positive jobs creation territory, and that's a tremendous achievement.
All right, but what about then, Nick? Let's throw into the equation, you're going to eventually have the Fed start to raise rates. Some folks say it may not happen until maybe next year, early next year, this time around next year. But that's going to certainly change the economics, if you will, of this kind of corporate picture, market picture.
And that's certainly true. And, Carol, I would say whenever the Fed does move, it's possible they could move earlier than what you're suggesting. But my conclusion would be that the bond market is going to move ahead of the Fed. And as, again, we saw even some indications maybe from last week of a forward-looking bond market. So we are going to be battling a rising Treasury yields. The other thing is, as we get to the turn of the year and we get, think about it, is tax rates on dividends and capital gains are headed higher. We know that's down the road. And it's weird. I would have thought that people would have focused on it, but I don't think they have just yet. Yeah,
not quite yet. Hey, one thing we are, though, focusing on today, Nick, is that news about the Treasury planning to sell its stake in Citigroup. I mean, this is the kind of news that we want to see and potentially sell at a pretty decent profit here.
That's correct. There's no doubt the thing that was most scary about what we went through was when we asked the question, was our financial system in meltdown mode? Citi was the epitome of too big to fail. So the fact that the government is now confident enough that it can sell stakes in a Citi, which is by no means been in the strongest shape of the major money center banks, that at least does tell you that the process has moved quite a ways.
Does it give you enough confidence to go out and buy those financials? I think they're up as a whole about 11% so far this year. Do you like the financials?
It's one of the sectors that we are overweighting because we do believe the expansion story. I think, though, that we have to be selective. I would admit that from past employment with Salomon Brothers, I actually have some Citi in my own portfolio. I'm not adding to it, but I haven't sold it, so I'm hopeful.
All right, what else would you suggest that investors add to their portfolio at this point, Nick? I think I got about 45 seconds left.
Yeah, we're really, I would say, overweighting cyclicals in our value portfolios right now. So the sectors, consumer discretionary, you talked about the consumer doing a bit better than expected. We mentioned financials. We do like the technology sector, both in our value portfolios as well as in our growth portfolios.
All right, we're going to leave it on that note. Nick, thank you so much. You have a great week.
Thanks.
Nick Sargen over at Fort Washington Advisors in Cincinnati.